I guess there was like zero.
All right, so we'll get going on this. Brian, what's up? How you doing? We've got
Good. How are you guys?
it- we've just got this is going to be a Brian session here,
I see
could
that.
be.
I see that.
Sometimes these topics really resonate with people. We'll have a dozen or 20 people on here, and sometimes people you know, are Christmas shopping, which is totally fine. But any questions, feel free to jump in. We wanted to put together some ideas for, okay, we're business planning for 2025. You want to figure out how many families you want to help, how many houses you want to sell. You want to focus on buy side, list side. You want to focus on certain riches and niches, whatever. But what if you are just saying, hey, I want to prepare my business and myself to be able to qualify for a mortgage? Whether it's your first house, whether it's your first rental property, whatever it may be. So we do these trainings on this particular topic about once a year to get people in the frame of mind where, okay, how does it work for self-employed buyers, right? What do lenders look at? And as such, how can I be best prepared to pull the trigger if I find a property that I really like next week or in 2025. Okay. So we're going to start with some of the more boring stuff, which is the nuts and bolts and the qualifying for a mortgage. And then we'll get into down payment requirements, using commission, rentals, and things like that. Okay. So when you talk about self-employed borrowers or buyers, most agents will fall under two categories. They're either going to be Schedule C, which is sole proprietor, or they're going to have an S corporation, which is a pass through entity. We're going to break down each of these and then how lenders look at them for qualifying. Right? What's up, Josette? How you doing? Ashley too, and Isaac. All right, Brian. It's no longer just it's just no longer just the four of us in here. All right, welcome everybody. All right, so a sole proprietor, right? This is when everybody gets started as a real estate agent. They're most commonly sole proprietor. They have an LLC and they own 100% of Buford Enterprises, right? Or Bank and Homes or whatever it might be, right? This is the easiest and simplest and most common self-employed income calculation. So if you take one thing away from this training, remember, and this is not just for real estate, this is for any self-employed business owner. The lender will take the net income, the after-tax income. On the Schedule C form of the tax return, it's always on line 31. So you might have people, and Brad and Matt and I have had this over our careers, where it's like, hey, my business made $1.6 million last year. Wow, that's awesome. Give me the returns. I love to look at this. Congratulations on your success. Well, yeah, but I also wrote off 1.8 million. Okay, a little bit different story, right? Because now your business's net income is actually in the red. Okay. So it is always a focus of what the bottom line is, the net profit or loss. It's not what the top line revenue is. That'd be one thing we would want you to take away from this. The net income is what matters. And then the calculation is actually really simple. There are Excel sheets that you can plug in different numbers. You could talk to your favorite one of us, Matt, Brad, or myself, and say, like, hey, look at my income from this year. I'm getting ready to file taxes. What would I qualify for? And we will send you this exact calculation. You start with the net profit or loss. Okay. You've got non-recurring expenses. That doesn't really come into play, nor does depletion unless your real estate operation is drilling for oil in the backyard. Okay. Depreciation, non-business travel, and meal expenses, you see that's a subtraction. And then the big one, section F, Foxtrot, the business use of home. Okay. I had Etsy shop owner in San Francisco that had a significant amount of her tax write-off was in business use of home. Well, that was great for her because that all is added back in the mortgage calculation, as is depreciation. Okay. So sometimes when you're working with your CPA on this stuff, it doesn't hurt to involve a mortgage professional to say, okay, how is this looked at? But the most simple calc here is, okay, what's the bottom line? $40,000. Then I had 10,000 in depreciation. I had 5,000 in meals and expenses. Okay, we went from 30 to 40. Then we subtracted out 5 grand for meals, and I had 15,000 in business use of home. That lands me at $50,000 a year. The lender is simply going to take that number from this calculation and divide it by 12 or 24. We'll get to that in a minute. And that's how they're going to generate your income. So Schedule C is super easy. It's just that bottom line figure plus a couple of add backs. And that's how the self-employment calculation is done. This bottom line text, there are 2 columns here. That's because if the business has existed for 5 years or more, a lender will average the last 2 years. So a lot of times people will come to me and say, hey, I just started my real estate. I barely sold anything in 2022, but I had a killer year in 2023. What do you think I would qualify for? Well, you might want to wait until you file 2024's taxes this upcoming winter, because then 2022 goes away. So if you had a bad year and then you've had 2 good years, you may wait for that tax return cycle, because that 2-year average, if you've got a bad year in there, it's really going to drag you down. 1-year averages. Brad, can you jump in and touch on this a little bit, because you've been really active in 1-year averages. And the baseline for a long time has been the business has to be around for 5 years. But there's some gray area there, is there not?
Are we good with the audio? Yes, there is some gray area. Sometimes if you're in sort of the same line of work and you're self-employed, but maybe you've started a new business, that's, just a new business, but same kind of work. Maybe you went from a sole proprietorship to you've hired some employees and you've just kind of restructured how you file your taxes. So that's sort of the main gray area. But I think we just kind of run across a lot of businesses that have been established for a much longer period of time these days. It seems like, the further, and I know we're very far away from 2008 right now, but I think the farther we've gotten away from that, the more emboldened people have become to become entrepreneurial again.
Yeah, and we'll keep this focused on your business, on real estate income. But one of the more common ones that I will see is truck drivers. Right? You've got a truck driver that
I will, dear. I promise.
has been driving for a certain amount of time with a license for 5 years or 6 years or 10 years, and then they shift over to a 1099 business. That's where you'll most often see, okay, well, gosh, we have a pretty reasonable target on their earnings. There will be exceptions made for that. But in the real estate industry, especially if you're a new agent, 2 tax returns and 2 solid tax returns is the best ticket here. Any questions about Schedule C before we move on to the different category, which would be an S corporation? All right. So a lot of times you'll see this, especially when someone has been an agent for. Oh yeah,
Yeah.
sorry.
Sorry, I got a
call right when you're describing that. Can I get like a 2-sentence definition of what a Schedule C means?
Schedule C.
Yeah, what is, sorry, of course, I got a phone call from a lender, right, when you were saying. Any of you can, I'm sure you want this question. What's Schedule C?
The way you file it back.
Oh, that's.
So basically-
Typical W-2s, there's a thing called Schedule C.
Yep,
Okay.
right after.
Good. I kind of like Mac being over Brad's shoulder. That's kind of like that look. And then it's blurry in some cases, and then he kind of comes into focus. All right. So question was about Schedule C, sole proprietor, 100% owner. Sometimes people will confuse, Mac, that's a good question. Like, well, I have an LLC. Okay. Like you can have an LLC and also be an S corporation, right? That doesn't matter as much in terms of those three letters. An S corporation is just creating a pass-through entity that can be a little bit more tax friendly. You'll see that with agents sometimes right out the gate, sometimes 3 years down the road, 13 years down the road, where they'll say, hey, I'm forming an S corporation because I think in talking with my CPA, that's the best move. No problem. And that would fall under Brad's category of, hey, I filed Schedule C 2 years ago, and then I filed S Corp. That's fine. You're still in the real estate business. That's not going to be a genuine concern, right? So they go for an S Corp. This is where you're going to file a separate business tax return. So unlike a Schedule C, it's not part of your individual return. It is strictly, your mortgage company, Buford Homes, right? You got Buford Homes and you got Ashley Buford. You've got two different tax returns that are required because the S corporation is its own business entity, right? You're not a sole proprietor. You may own 100% of it, but it is its own entity. All right. So this can be used by sole props or individual entrepreneurs to benefit from an S corp structure, like avoiding double taxation. The good news is the calculation is pretty similar. Okay. The baseline is if you own more than 25% of the business, you're going to be considered self-employed. All right. So you might have partnerships or you might have small stakes. I own 10% of this business over here and I own 20%. Okay, if you're less than 25%, then that's a whole different ball of wax. But if you're more than 25%, which most real estate entities are, right? You're not splitting your commission 5 ways, right? Then you're going to be considered self-employed. If you're an S corp, the way the lender is going to look at that is that they're going to take the last 2 business returns and then they're going to add in your W-2 wages plus distributions from a K-1. Okay. Now, I don't want to get too deep in the weeds on tax stuff here, but a K-1 is a partnership statement. So let's just say your real estate company pays you $4,000 a month and has done that consistently. That's great. And that's one of the benefits of this S Corp structure is, hey, Buford Homes is paying Ashley Buford. Sorry, I'm not picking on you, Ashley. Buford Homes is paying Ashley Buford $4,000 a month. That means Ashley can use that $4,000 for qualifying. Okay. Now you've got to have a history of paying that salary, but you get that solid salary in place. On top of that, Buford Homes, which is owned 100% by Ashley, also made $48,000 that she took out of the business or didn't, but the corporation made an additional 48 grand. Then we're taking her salary that she's paid herself plus what the company made. You add those together and average over 2 years, and you've got $8,000 a month in qualifying income. Now, guys, I want to be clear. A lot of times, and Matt, Brad, jump in on this. A lot of times we will see business owners that say, I just started my business and I started paying myself $10,000 a month. What can I get for a mortgage? Right? There has to be a seasoned history of you having paid yourself before you can use that for qualifying income. right? A lot of people say it's W-2, who cares? Well, yes, but once they dig into it, they're going to determine you're self-employed and you're going to be right back in that self-employed bucket. Okay. Questions about Schedule C. See, it's confusing me. It's questions about S corporation and how this is structured. And this is something that we could talk about one-on-one as well. I mean, if you say, hey, this is my situation, I've had so many agents, and I know Matt and Brad have as well, that come to us around this time of year and do these calculations. This is just a, not a 30,000 foot view, but maybe a 10,000 foot view of the different structures. Okay, cool. That's the hard part. The hard part is just figuring out the qualifying income. Everything else is pretty simple, which we're going to cover in these following slides. So once you have the income pinned down, just about everything else is exactly the same as if you work for Target with a W-2. Okay. The down payment requirements, the credit requirements for self-employed borrowers are almost precisely the same as a standard W-2 earner. So what does that mean? Well, let's talk about down payment. 3% down as a first-time home buyer, and or if you're under the area median income, which is about $99,000. So let's go back to that S Corp idea for a second. $8,000 a month in qualifying income, that's $96,000 a year. If they were buying in the county metro area, they'd be under the area median income. They could do 3% down. They could do a 2-1 lender funded buy down. They could do 1% down, right? All sorts of options. So again, all of these programs that we talk about on Tuesdays and in some of these Wednesday meetings that we are giving as a benefit to your buyers, it's not like you're excluded from them because you're an agent or because you're self-employed. All of those are exactly the same. Does that make sense? Sweet. Now, conventional will play most nicely with credit scores above 680. Doesn't mean that you can't get a conventional loan down to 620, right? But the cost might be prohibitive if you are below 680 and opt for a conventional loan. Okay. If you're below 680, a lot of those buyers will opt for an FHA loan. That's 3.5% down. There's no income limit at all. And you don't need to be a first-time buyer. Okay. A lot of people think that FHA is only for first-time buyers. Not the case. Not the case at all. Now, you can't have two FHA loans at the same time within 100 miles of each other. But it's not like FHA is only a first-time home buyer program. And then, of course, if you're a veteran, 0% down, no uniqueness about being self-employed there. That's a VA home loan earned benefit that applies regardless of whether you're a W-2 earner or self-employed. And then USDA, same, 0% down if in an eligible area, which you can find that online. If you Google the USDA eligible area, you can plug an address in. Matter of fact, you might be going out to Glencoe and say, hey, my buyer doesn't have a lot of money for a down payment, but they might qualify for USDA. I wonder if it's eligible. I'm going to plug this address in. Boom. One more thing to talk about, show off your professionalism. And then MHFA, Brad, what's the limit on the MHFA step up now? There are a number of different options available up to what, 178,000, something like that?
Yeah, I don't have the exact number handy, and I think that number is probably going to go up here in maybe a week or so as we go into 2025. But yeah, the number is pretty hard to get above on that step up program. I mean, it's way up there, kind of right, between $150,000 and $200,000. So even for a couple, and maybe they have son who is still living with them, who is working, you know, a lot of times that startup program is a really, really great option. If you are concerned about, needing down payment assistance, but, making too much money, startup is or step up, is a great program. Same for refinances. You can use it to refinance as well.
So bottom line, income calculation, different. Credit and down payment, the same for self-employed folk like yourself. Applying commission toward down payment. Okay, hey, I want to do a 3% down conventional loan. I found a property and I want that commission to shore up my down payment. You can do that. EXP allows this. I think most brokerage allow this in general. Might be something to bring to your pod leader or one of the TCs. Talk to Ian or Allison or Liz or whatever it might be. Liz Gust. You can talk to Liz Ryan too. But you know, so if you negotiate a 3% commission with yourself, you know, and get that signed before you show a property, that's kind of clever, right? Then you should be able to apply that down payment toward that commission toward the down payment. A lot of people have done this. It's a great advantage. Look, you guys are the professionals that have gone through the training. You've gotten licensed. You've maintained your license. Might as well take advantage of one of those benefits, which is commission toward down payment. And then lastly, I just wanted to talk for a moment about rentals. So many people will come to me that don't own a property and say they want to get going on their rental portfolio. I say that's great, but start with an owner occupied property. Doesn't have to be a fourplex, doesn't even have to be multifamily, you know, but the benefit of starting with an owner occupied property is number one, the down payment is so much lower when you buy a primary residence that you're going to occupy for 1 year, right? So if you go and buy a single family home, you're back into this category of 3%, 3.5%, or zero if you fall in these latter two groups. You know, if you're buying an investment property, it's going to be minimum 15% down. And realistically, it's more 20 or 25% down if you want to get a really attractive rate and term, right? So, you know, you buy it and you only have to live there for a year, right? And then if you want to move on to something else, you can. But so many people are champing at the bit to get rental property and they don't realize that buying it owner occupied and living there for a year is the best way to circumnavigate the barrier to entry that is investing in real estate. Number one hardest thing about investing in real estate, coming up with a 20% down payment every time. You know, you buy a $400,000 house, that's 80 grand. That's for most people not walking around money. So that's something that I would encourage you to look at. You know, we all find deals and things like that, and there's nothing wrong with that. But if you can live there and sign that affidavit of occupancy that this is going to be your home for the next 12 months, then your options become a lot greater than just buying an investment property. We like to keep these to 30 minutes. We haven't the last couple of weeks, so I'm kind of glad that we're wrapping here closer to the bottom half of the hour. Any questions about anything that we talked about here, y'all? Matt, Brad, anything you guys want to add? Brad?
I actually have a file going right now with an agent that I worked with, and actually I've known outside of real estate for quite a while. But she is using the One Plus program. So she's got One Plus, she's got some seller paid credits, and she's converting her commission to the closing. And she's basically walking into closing with, hey, my earnest money cashed. I'm walking into closing with my ID and a letter from my broker, you know, confirming the amount for the commission. And that's it. So it's, you know, using that commission and using your negotiating skills and market understanding as an agent is a really great way to get into a property, whether you want to build a real estate portfolio or not. But again, to Colin's point, this agent, her plan is, I want to build, a pile of rentals if I can, and I want to hold on to as much cash as I can on this first one to make sure that in 12 months I can do the same and really tackle the next one. So you guys have, not only probably the best, most flexible options, because you can use your commission towards the purchase, but you also have your ear to the street a lot better than an average consumer would. So I would encourage anyone who is a realtor, who maybe doesn't own their own home quite yet, to, think about maybe making that one of your goals, as Colin said at the start of the training, for 2025, because it is an option. It is to Colin's point, sometimes it's more difficult for newer agents. But once you get your footing in real estate, I think owning a home will only help you kind of appear as more of an expert. And just the fact that you've gone through the process more, I think you'll be able to kind of, empathize to all your clients. So if it's not on your goals for 2025, I would strongly urge everybody who does not currently own a home to make it a goal, or at least something to explore and chat with any of the three of us and figure out where you do stand and what you need to do to get prepared in 2026 if it's looking like that might be the year. So, but thank you everybody for coming. I really appreciate the interest in this. I think it's a good thing for both your career and just your personal finances.
Yeah, thank you guys.
All right, you guys, we're here to answer questions as they come up. That might be as you're prepping taxes or whatever it might be. But happy to be a resource for you as you guys put a plan together, whether it be at 25, 26, or whatever it might be.